very respected and great speaker of this evening, Chartered Accountant Advocate Ashish Makhija from New Delhi, Secretary of SIRC Panaraj sir from Bellary, the Treasurer of SIRC CA Revati Raghunathan Madam from Chennai, CA Geeta from Bangalore, senior members, friends, very good evening to all of you. It gives me great satisfaction to once again join with you all for this wonderful and important evening session. On behalf of SIRC, I welcome the great speaker of this evening and express my sincere thanks to our learned resource person, Chartered Accountant Advocate Ashish Makhija, for accepting our request and share his wisdom amongst our elite professional gathering. I also welcome each one of the members who are all participating this evening program, and I deem it my pleasant duty to offer my hearty thanks to the members whose support by their active participation to our SIRC programs has been instilling confidence. We have great professional opportunity relating to the independent directors, and the same time we have the huge responsibilities to discharge our duty to the stakeholders. Hence, we have to know our roles and responsibility in effective way. Then only we will do best service to the corporates. We strongly believe that that the involvement of professionals like us in day-to-day affairs of the corporates will increase the performance of the company, which will result in holistic growth in the industry and economic as well. Keeping this in our mind, we have organized this excellent program. I'm sure the exposure that the participants will get on the subject of presentation by the speaker of eminence and his expertise will broadly update our understanding on our roles and responsibilities of independent directors. With this request, the Dynamic Regional Council member, AP Geeta from Bangalore, to introduce the speaker of this evening for the benefit of the members.
Distinguished Chairman of SIRC of ICAI, CA Jalpati sir, Secretary CA Panaraj, and Treasurer CA Revati Raghunathan, and the person who has been well versed among our members as a vivid speaker on IBC subject, CA and Advocate Ashish Makhija sir, and my dear virtual viewers. Happy evening to all of you. I thank the Chairman for giving me an opportunity to be a part of this session and have the privilege of introducing today's speaker. Ashish Makhija, a leading practitioner in insolvency and corporate law matters. As a managing attorney of AMC Law Firm, a firm headquartered in New Delhi, he bears top credentials in corporate law, insolvency and bankruptcy law, corporate litigation and advisory. He was the standing counsel for the official liquidator attached to High Court of Delhi for 6 years, handling many large cases of corporate insolvency and liquidation. He regularly appears before Supreme Court, High Court, NCLAT, NCLT in insolvency, bankruptcy, corporate law, and arbitration matters. He has been a rank holder throughout his studies. Ashish Makhija has 14 books to his credit on the subject of insolvency and bankruptcy and corporate law, and he has a significant corporate board experience. Has served as an independent director in Shipping Corporation of India Limited, Caterpillar India Limited, and other public and private limited companies. Sir is a avid contributor of articles in journals and online portals of repute. With this very, very brief introduction, I'll pass on the virtual stage to Ashish Makhija, sir. So over to you, sir.
Okay, thank you and very good evening to all of you. I think it is always a delight to be amongst the fraternity, particularly the chartered accountants. Well, friends, I may be an advocate. I'm practicing as an advocate, but I always say that at heart I'm a chartered accountant, and I'm proud to be a chartered accountant. And wherever where I stand as an advocate, it is because of my chartered accountancy profession. So I owe everything to this, my profession. So it's always a delight, and particularly you see the Southern India Regional Council. I think the chairperson, the secretary, the treasurer, and the other members, I think that fantastic team do you have, and you are conducting excellent programs. And may your breed increase and you continue to organize such programs for the benefit of the members. And I must thank Revati ma'am also, because I think we have been in touch with the for other programs also, and she has been very particular that for independent directors we should also conduct a program here also for the members. So friends, here I am, and I'm so delighted to be amongst you. Friends, before I deal with the subject of role and responsibilities, I don't want to go too much technical, because those are the provisions. We being chartered accountants, we can read all those provisions. I will take you on a broader perspective, but first thing which I would like to mention is this, that we as chartered accountants, I think we must take onus on us now to become directors in the companies, because I believe that chartered accountants can contribute in a larger extent, to a larger extent in the companies when they become directors. See, we are people who are ethical people. We know our boundaries. We are excellent in knowledge part insofar as corporate law is concerned, insofar as accounting, auditing, and finance is concerned. So why not, you see, take up those kind of responsibilities today? I think the chartered accountants can become the best independent directors, and they have shown over a period of time also that they can contribute to a larger extent to a company. So I think I must encourage all the chartered accountants who are here. But one question which comes to our mind is this: if I become an independent director, what happens to me if something goes wrong in a company? Now that's a $1 million question, and no easy answers. My only suggestion is, my dear friends, is that please try to create a safety net around you. If you are a director in any company, be it as independent director, be as managing director, be as any part-time director also, well, you need to ring fence yourself. The problems are bound to come. There is no quarrel on that. One day or the other, a good company may also start facing problems tomorrow. So there will be, you see, bouquets also, there will be brickbats also some other day. But if you have ring fenced yourself, what I call it as a safety net, well, then, my dear friends, you are absolutely safe. Because we are living in the era of corporate governance today. Well, corporate governance is a combination of two words, corporate plus governance. This came into limelight, well, in the 1990s because of, say, Arshad Mehta scam, and then there are many other corporate scams, and then also Ketan Parekh securities market scam, and so forth. And we have seen the days of even Satyam also. So where the chairperson of you see Satyam, he faxed, you see, a document to the SEBI saying that you see, he's riding a tiger and he does not know how to get off that tiger. So that's you see, a statement which actually the government took notice of. Friends, there the requirement of independent directors was definitely felt. That look, if the directors were really independent, of course we may have independent directors, but the question is whether they are really independent or not. And then the liabilities can definitely come. So how to you see, overcome those liabilities? I'm not saying we need to escape the liabilities. Well, I'm not saying that we should not be escaping the liability, but at the end of the day, we must make sure that the liabilities which are coming upon us now, they are reduced to a larger extent. So this is very important, friends. So now what I'll do is I'll just share you see, my presentation, and then you see, we will take up the other aspects. So I hope my presentation is visible now.
Yes, sir. Yes.
Okay, let me.
Yes,
yeah,
sir. Yes,
so
sir.
let me increase the size. Yeah, now I think it is better. So what I'm talking not only about the independent directors, but I'm talking, you see, the board's legal environment and corporate governance also. Because you see, if we understand the entire legal environment under which the board of directors function, then we will be able to understand what is my role, what is my duty. I mean, not only we have to understand the role, but as an independent director, I must understand my duties also. And if we are performing our duties in a proper manner, well, I don't think there is anything to be afraid of. So friends, let me take you back to, you see, I call it as a rear view mirror, but I'm taking you back to Companies Act 1956. Of course, Companies Act 1956 is not here nowadays, but let me take you to Companies Act 1956. What does it say? It contained 658 sections if we on the face of it, but we count, you see, A, B, C, D, all sections. It was such a voluminous act, and it contained almost around 900 sections. So it was a huge, you see, act which was there. 16 schedules were attached to it. Well, friends, I think legally speaking, schedules are as much a part of this section. Only as a matter of convenience that some information is put in the schedules, but otherwise it's as effective as the sections only. And we all know that in India, if we have to go to look at the definitions, we have to go to section 2 of any statute. So Companies Act was also no different. Section 2 contained almost around 66 sections. So what do you mean by director or managing director? So all those kinds of definitions we can find out in the definition sections. And then there were 34 sets of rules and regulations. Now, my friends are aware that rules and regulations are generally framed by the central government under the delegated powers, because no one wants to go to the parliament time and again. So some powers are delegated where a flexibility is granted to make rules, and that is generally given to the central government. So there were 34 sets of rules and regulations under you see the Companies Act 1956. Now, to understand the role of the independent directors and how this concept has developed over a period of time, particularly in case of corporate governance also, I think I need to take you to the certain history which was attached to it. Why the government actually wanted to replace the entire Companies Act. Now, in 1993, after the economic reforms which were introduced in the country in say 91, 92, then this was also part of the reform, and also because the Harshad Mehta scam and some other scams which were occurring across the world. I mean, not only in India, even across the world, there were a lot of scams which were there. We know that there was Enron scam, Xerox scam, and so many other scams were appearing. Now, government actually wanted to replace the entire 1956 Act with a new bill or new act, which was introduced in the Parliament in 1993. Now, the idea was that they did not want to alter or amend Companies Act 56 because it would have been too cumbersome. So they said, let's begin with on a new slate. Let us try to replace Companies Act 1956. Probably by that time, government felt that it has lived its own life. This bill was introduced in the Parliament in 1993, but unfortunately, friends, this bill could not see the light of the day, and this bill was not passed. And then in 1997, Companies Bill was introduced for the second time, replacing Companies Act 1956. But unfortunately, again, this bill could not be passed. In fact, this bill was also introduced in Lok Sabha, and the term of Lok Sabha expired in 1998. And all of us know any bill which is pending in Lok Sabha, and if the term of the Lok Sabha expires, all the bills lapse. So this bill also lapsed. Then from 1997 to 2003, nothing happened. Then the government actually went into, say, what we call it as a version 2.0. They said, instead of now going back to Companies Bill 93 or 1997, because again, in the last 10 years, many dynamic situations have changed. So therefore, the government came out with a concept paper. They said, we are not amending the Companies Act right now. We are just issuing a concept paper that what should be the shape of the new Companies Act. So they, you see, issued that paper. This concept paper, friends, was discussed, debated amongst the chambers of commerce, professional institutes, and the corporate world, and maybe amongst the academicians and others. So then the government actually wanted a lot of recommendations. They said, pour in your suggestions. And I think those who are aware and who had a keen interest in Companies Act in that particular year, well, we know that our institute also and other institutes conducted a lot of seminars on this concept paper also. And based on the concept paper, understanding the provisions, then huge number of suggestions and recommendations were received by the central government. Now, to look at those recommendations, to look at those suggestions, the government actually formed a committee, which is a very popular committee. You know that J.J. Irani committee. So J.J. Irani committee was formed to consider the suggestions and the recommendations which were received pursuant to the concept paper. Now, this J.J. Irani committee, after considering the recommendations, submitted its report. And based on that report, the government actually introduced Companies Bill of 2008. Unfortunately, the term of Lok Sabha again expired, and therefore the bill also lapsed. Then the government introduced the same bill as Companies Bill 2009. Let us look at what was the proposal. We have already seen historically what was there in the Companies Act 56. Now the government wanted the number of the sections to be reduced to almost 50%, 426 sections. So instead of 881 sections, the government said we're going to have 426 sections. And no schedules were proposed. So from 16 schedules to 0 schedules. The definitions went up from 66 to 93. Two reasons. The first reason was some of the definitions were scattered throughout the Companies Act 1956, just like holding company and subsidiary companies were defined in section 4. So they were also brought under the umbrella of definition section, which is section 2. And then definitely some new concepts were being introduced. So new definitions also came into being, like key managerial personnel, and we had the definition even of auditing standards, accounting standards, and so on and so forth. Because a lot of new concepts were being introduced, so new definitions also came in. So these were the two reasons why the definitions increased. But look at this, friends. The phrase "as may be prescribed," now it appeared 235 times in Companies Bill 2009. And you know what is the meaning of "as may be prescribed"? I think everyone is aware of that. As may be prescribed means we will have definitely a rule or a regulation in relation to that. So what is the situation? Look at this. So the number of sections in the Companies Bill was proposed to be reduced to 426, but the number of rules will go up from 34 to 235 times, to 235 number. So look at this. So by this, what you are getting? You are actually getting a feeling that the sections are being reduced, but the portions which were part of the substantive act, now they have been taken out and they are being given, to the central government to make rules. Well, the central government had a logic behind this. They said the corporate world needs amendments or changes too frequently because it has become very dynamic. So central government needs to have some flexibility, and flexibility to the government comes under the rules, because the rules can be changed easily, not the act. If they have to change the act, they have to go back to the parliament every time. So this becomes a cumbersome process. So therefore the government said we need flexibility to change according to the change in time. So that is why they said most of the things will fall under the rules or as may be prescribed. But anyhow, friends, 2009 bill was also not passed. This bill was referred to the Standing Committee of the Parliament, and they also made some suggestions or recommendations. And based on that, plus one more event also happened, which I'll just tell you. Now, the new Companies Bill 2011 was introduced in the Parliament, which actually became Companies Act of 2013. So present statute of Companies Act 2013 owes its genesis to Companies Bill of 2011. Now let's look at the present statute. Now present statute is Companies Act 2013. Now when it came, it used to contain 470 sections. So instead of 426 sections, which were proposed in Companies Bill 2009, now Companies Act 2013 was passed with 470 sections. Now and 7 schedules also resurfaced. 4 were old schedules in a new shape, and 3 new schedules were added in the Companies Act. They have been added now. And the definitions, of course, went up little bit, 95. So instead of 93, we had 95. But this is interesting, friends. The phrase "as may be prescribed" now appears 346 times in the Act. So instead of 235 times, it rose up to 346. You must be wondering why the number of sections increased from 426 to 470, and then the number of rules increased from 235 to 346. Well, friends, simple answer. This was because of Satyam. What happened in Satyam, we all know. The fraud was of a very great magnitude, around 6,000 crores or 7,000 crores. The government, which wanted to give lot of powers to the corporate world, they wanted to dilute their own inspector Raj or maybe the government control, and they wanted to give it to the corporate democracy. But when Satyam happened, the government thought that right now the corporate world is not mature enough to handle these situations. So therefore, some more provisions were brought in, and therefore the number of sections increased from 426 to 470. And similarly, the rules part also increased from 235 times to 346 times. So now, and not only that, not stopping here, friends, 46 sections of Part 9A of the Companies Act, which relate to producer companies, they also continue to apply to Companies Act 2013. So let's do a small arithmetic. 470 plus 346 plus 46. So the total is 862. I hope I'm right. I think chartered accountants are always right. So 862. We started with 881 sections. We are back to 862. Have we reduced the volume? If somebody asks me that questions, the answer is no. So the volume in the Companies Act is as much as it was under Companies Act 1956. Of course, the penalties have also gone up. So that is also one of the interesting aspects. So this is the, I'll just give you a very broad helicopter view of the Companies Act 2013, just to understand a role of being directors also. That's very important. This Companies Act, friends, is very easy to understand. If we understand it this way, it is divided into 29 chapters. Chapter 1 deals with, as we know, applicability and definitions. So this is a very small chapter, only 2 sections are there. And then this contains, chapter 2 contains almost around 20 sections, and it deals with incorporation of the companies, memorandum and articles of association. So we all know memorandum and articles both are the charters of the company, and they are very important documents. So this is one of the suggestions which I can give you, and of course you may be knowing it, but the point is, if you are becoming a director in any company, or you are already a director of the company, please get a copy of memorandum of association and articles of association. It must be in your personal library. That is extremely important, friends. Mark my words, because I'll show you one of the provisions which are in my slides also to show that why it is required. Then, of course, we have chapter 3, which talks about prospectus. Again, 20 sections are there, because a company which needs to issue a prospectus has to follow certain this thing. And chapter 3 talks about that. Chapter 4 deals with share capital. So once the prospectus is issued, shares money is invited, the company is bound to issue the share capital. So 30 more sections are devoted to share capital. And then some companies may also take deposits from public. So we all know what is the definition of public deposit. So I'm not going into it, but I must draw your attention to one of the important things. Chapter 3, prospectus. Chapter 5, public deposits. Friends, both these chapters are extremely crucial chapters. Mark my words, if you are a director in a company which is going to issue a prospectus, or which has taken or is going to obtain public deposits, you should be extremely cautious. You should be extremely careful, because these 2 chapters are one of the most dangerous chapters in the Companies Act. Any chapter or anything to do with the public money, government is serious about it, and serious consequences can fall upon the directors. So please be extremely careful while a company is issuing a prospectus, because any single misstatement in the prospectus can lead to serious consequences. And mark my words, prospectus, once it is approved in the board of directors, well, all directors are party to it. So therefore, one has to be careful while dealing with this. Chapter 6 is a very small chapter. It talks about registration of charges, because the charges which are registered, well, they should become they should be on the public domain. So any person should know it. Chapter 7 is also important. It deals with management and administration of the company. And there are around less than 40 sections are there. If you are a director, well, this is one of the chapter which you must go through it. And then dividend is very small chapter, only 5 sections. Chapter 8 talks about dividend, and chapter 9 and 10, they deal with accounts and audits. I think most of us are aware that they deal with accounts, audit, and auditors. These are 3 extremely important chapters for directors to know. 11, 12, and 13, they talk about directors, board of directors, and remuneration, which the directors are entitled to. So these 3 chapters are extremely important insofar as the directors, management, other things are concerned. So if you are a director, friends, whether you have read other sections, other chapters or not, these chapters, chapter 7, 9, 11, 12, and 13, you must go through it. 14, then you see, gives powers to the central government for carrying out inspection or investigation, because something can go wrong, somebody can file a complaint, so those things are possible. Chapter 15 deals with mergers of the company, mergers, demergers, compromise, arrangements. Those kind of activities are mentioned there. Chapter 16 deals with operation and mismanagement. 17 is only one single section, one chapter, registered valuers. And then we have removal of names of the companies in chapter 18. We know that many names of many companies were removed by the registrar of companies. And supposing somebody doesn't want a company also, so there is an option of getting the name of the company removed, so that the responsibility for filing balance sheets and that will also cease to exist. Chapter 19, which deals with revival, well, that has been deleted from the Companies Act. So it is no longer there on the statute books, because now revival and rehabilitation is under a new shape, under a new name, which is known as insolvency resolution. So we are trying to resolve the insolvency of the company. We are trying to revive and rehabilitate the company. It means the same thing. But these provisions, as we all are aware, that they have been transferred to insolvency and bankruptcy code. So now the commercial insolvency of the any company or its revival will be dealt by the insolvency and bankruptcy code. So that is also another, you see, act which I think the directors must be aware of that. Chapter 20 is one of the largest chapters, friends. It talks about winding up of the companies, almost around 109 sections, which means almost around 20 to 25% of the entire act, which is there. Very important section. And 21 is companies authorized to register, to register under the act. So this is a very small chapter. Then we have foreign companies in chapter 22, government companies in chapter 23. 24 talks about registration offices and fees. Companies to furnish information is in 25. Nidhi companies, which are called as mutual benefit society companies also, well, they are dealt in chapter 26. Most of them are in the southern part of the country. So probably in your part, you may be seeing Nidhi companies, but in northern part, western part, there are very few companies. Then NCLTs are, which is a new body now. Earlier we used to call it as Company Law Board. Now there is no Company Law Board. Now we have National Company Law Tribunal. So National Company Law Tribunal, you see, deals with that is dealt in chapter 27. So that's a separate chapter now. And then special courts. Why special courts? Well, if registrar of companies wants to file a complaint against the directors or the company, First, mark my words, friends, this is a criminal complaint. It has to be filed before the metropolitan magistrate or magistrate of first class, whatever you may call it in state-wise. But this is known as this. So what the director have to do as a first thing, the directors have to obtain a bail if registrar of companies files a complaint before the court. Now, what used to happen under 1956 Act was that a magistrate or the judge who was dealing with all kinds of criminal matters, the matters under Companies Act were also dealt by the same magistrate or the same judge. So directors were also standing in the courts where the ordinary criminals were also standing, like those who are accused of murder, rape, and so and so. The government thought that, look, as far as the directors are concerned, we should not club them with other criminals. So therefore, they actually decided that we should have special courts. So now there are in every state a court which has been designated as a special court. Well, while they are taking those matters under the Companies Act, they will not take up any other matters during that time. So now in the courtroom, you will find the offenses relating to Companies Act will be dealt with. And this is the last chapter, which is known as miscellaneous. Miscellaneous means rule-making powers of the central government. So chapter 19 is there. So this is the broad layout. And then I told you that there are 7 schedules attached to the Companies Act. Number 1 is schedule number 1, which gives us the templates of memorandum of association and articles of association, tables A to I. Schedule 2 deals with depreciation. This was, you see, a different schedule earlier. Schedule 3 is balance sheet, which was schedule number 6 under the Companies Act. So now it has become schedule number 3. This is a new schedule, friends, code for independent directors. Now, if you are an independent director, now this is extremely important that the code for independent director must be read by must have been read by the directors. Now, this is extremely important because if we don't read the code for independent directors, then we may be exposing ourselves to certain liabilities. So this is one of the important schedules which must be read by the directors, or particularly the independent directors. So that is very important, friends. So don't leave this particular schedule. If you get a chance, please go through this schedule. This is extremely important for the independent directors. And it, you see, actually talks about a lot of things which are there. It basically gives us the guidelines for the professional conduct. It is nothing but a ethical code, basically, that we can talk about. The roles and functions of the independent directors are also greatly mentioned there. Even the duties of the directors, their manner of appointment, how they should be appointed, how they should be reappointed, then how they can resign, or they can they be removed or not. Then it also talks about separate meetings of independent directors to be held, and it also deals with the evaluation mechanism, because the performance evaluation of independent directors is required to be done now under the Companies Act. So this is extremely important, that if you are a director or particularly independent director, go through this code for independent directors in Schedule 4. Schedule 5, friends, talks about the managerial personnel, that what is the remuneration, maximum remuneration that can be paid in a public limited company. It was earlier Schedule 13, now it is Schedule 5, but it has been liberalized to a larger extent. Schedule 6 talks about infrastructural projects. Schedule 7 is extremely important. It talks about, because a new concept has been introduced under Section 135, corporate social responsibilities. So now some of the companies which are now liable, now they have to keep aside certain funds, percentage of their net profits, as CSR funds. And not only CSR funds, they have to actually spend that money. So they say you have to spend that money on CSR activities. But if you can't spend, then obviously you can carry it over, provided you are you see, investing in a project. But if you are not investing in a project which is undertaken, then of course you have to spend it on other activities. So what activities on which it can be spent? those list of activities is given in Schedule 7. So that is the 7 schedule. Now, friends, we have seen that Companies Act is a voluminous legislation. Well, lot many sections. But this Companies Act contains provisions from birth to death of a company. Now, how do we look at these provisions? Let us compare the life of a company with the life of an individual. So then probably we'll be able to understand. Now, birth of a company or individual can be equated with the incorporation of the company. So when we say incorporation, that means the company has taken birth. The life and times of an individual can be equated with the management and governance of the corporate world or the companies. The marriage of an individual can be will be equivalent to the mergers or acquisition by the company. And of course, divorce can be equated with the demerger. Children would be subsidiaries and associates and joint ventures. They can be equated with that. Illness of an individual could be the sickness of the company when the companies do become sick, and then of course they need to be revived or rehabilitated. That is known as recovery. And then the last is the death of a individual can be equated with the winding up or the last step of winding up, which is dissolution of the company. So friends, if we look at the right part of the slide, Companies Act actually contains the provisions relating to starting from the incorporation of the company and going up to the winding up of the companies. So you will find incorporation chapters in the beginning, winding up chapters at the end, and all these other management and administration in the middle, like management, governance, mergers, and other revivals and other parts of it. So this is the way, very easy to understand the Companies Act. Well, this is one of the books which I have also authored, and it is talks about company law ready reckoner. Well, just a small caution, though it is a company law ready reckoner, friends, now it also contains more than 2000 pages. So be very cautious, because in any case, companies are, you see, there are a lot of provisions are there for the companies. So the company is an artificial juridical person. We all know that. I don't have to repeat on that or explain that. Companies have separate legal entity. We all know. Company is to be run as a going concern, but the going concern concept can also be lost. The corporate wheel can be pierced if there is a fraud in the company or there is some avoidance of taxes and all that aspects. The courts can obviously definitely pierce that wheel. And we all know that in a company, we have the directors and the shareholders have a limited liability, but only limited liability is only to the extent if there is no fraud. If there is a fraud, definitely there will be a higher liability, friends. Now, these are the types of the companies under the Companies Act. I think most of us are aware. Earlier, we only had private companies and public companies, but now under the Companies Act, we can also incorporate OPC, which is known as one-person company. Basically, they are private limited companies, but yes, these type of companies can be formed. And then in public limited companies, we have two categories. Either they could be unlisted public companies or they could be listed public companies. Friends, are you aware that by looking at the SIN, CIN, well, I'm talking about SIN, not SIN SIN, but I'm talking about the corporate identity number. Now, by looking at the SIN, you can gather many things about it. I'm not sure how many of you know it, but SIN is a 21 alphanumerical number, which actually gives you a lot of things in that. The first letter itself conveys a lot of meaning. The first letter is an alphabet which could be either U or L. U means unlisted and L means listed company. So this is what we get an indication from the SIN number. So just look at the SIN of any of the company and you will be able to decipher many things. So first is an alphabet, either U or L. Then we have got 5 numericals. So we have got 5 numericals thereafter, and this numerical, my dear friends, represent what? it represents the business of the company. If you go to if you go to internet, you will find, just Google NIC codes, right? NIC codes. You will find the coding, and there you will find that the business of the company is divided into that code. So if some company is into, say, cement manufacturing, it will have a different code. Some company is in, say, manufacturing of textiles, it will have a different code. And if it is in a software business or logistics or service industry, so there are different codes out there. So by looking at that code or looking at that SIN, we can actually gather what the business of the company is. Friends, let's do this exercise. Randomly pick up the SIN numbers and try to compare with the NIC codes. You will get to know what is the business of the company by looking at the CIN only. That is extremely important. Okay. Then the next are basically the two alphabets, and those two alphabets are something like say MH, TN, DL. Well, it indicates the state in which the company's registered office is located. So MH would mean Maharashtra, TN means Tamil Nadu, DL means Delhi, and so forth. So it also tells you in which state this company is registered. With which registrar. Okay, so it will only tell you the state. Of course, as far as the registered office is concerned, you will have to look at where it is located. And then next four are the numericals, and next four numericals are something like 1989 2020. Now what does this represent? It gives you the year of incorporation of that company. So by just looking at the SIN, we can know how old the company is. So that is, it will give you the year of incorporation. And then again, my dear friends, we have three alphabets, and these three alphabets are like PLC, PTC, which gives us the type of the company. If it is PLC, that means it is public limited company. If it is PTC, that means it is private limited company. So therefore, by looking at the SIN itself, we can get to know what type of company is this. And lastly, my dear friends, we will have 6 numericals, and those 6 numericals will represent the registration number of the company. Now, this is the way the whole, you can say, it is designed, and the entire coding is done on this basis. Okay, so SIN number is a very important number. Have a look at the SIN, friends, and you will get to know a lot of details as I mentioned just now. Well, of course, I can skip this, that 1% company has 1 shareholder minimum and minimum 1 director. I mean, it has only 1 shareholder and minimum 1 director. But in OPC also you can have more directors, but shareholder has to be only 1. And OPC must be used as a part of the name. So if it is used, then you know that it is the 1% company. But the law says it is basically a private company. Now, what do you mean by a private company? I think most of us are aware, minimum 2 shareholders, maximum are 200 nowadays, excluding the past and present employees. Then directors are minimum 2, maximum 15 in a private company. But if we want to increase the directors beyond 115, well, that is also possible, but it will require the approval of the shareholders by special resolution. So this is another thing. And of course, public company, we are all aware, minimum 7, maximum no limit. Directors are 3, maximum 15, and beyond 15, again, it requires the approval of the shareholders by special resolution. And public companies can be listed and can be unlisted. So friends, what do we get from here? So number one, wherever I'm a director, whether in a private company or an unlisted public company or listed public company, now my role and my responsibility changes with that. This is also very crucial. If I am a director in a listed public company, friends, please mark my words, your role is much higher, your responsibility is much greater. So you have to be more extra cautious, because the corporate governance requirements do also change with the status or the category of the company. If it's a listed company, not only Companies Act applies, but even SEBI, which is a regulator, they also regulate such companies, and they have made a lot of regulations now. We all know that when you issue a capital, now it is ICDR, issue of capital and disclosure requirements. Then if it is listed company, then we have LODR, listing obligations and disclosure requirements. So all those regulations are required to be followed. So public limited companies which are listed, definitely they have to follow Companies Act, and beyond Companies Act, they have to follow the SEBI guidelines, SEBI rule regulations. Now, some people do ask me a question that if there is a clash between the SEBI regulations and the Companies Act, which one we should follow? Well, friends, the answer is simple. Follow the strictest one. The strictest one needs to be followed in case of there is any inconsistency between the two acts which are there. Now, friends, what I can show you, because some people definitely do ask me, and they are curious to know that what is the role of the board? What is the responsibility of the board? Now, and how the board can succeed. Friends, if we look at the other side of the coin, why the boards fail? Now, if we understand that on a larger basis, then of course we know that you see the idea you get that what are the reasons why they are failing. So what is the reasons for success also can be taken out of it. I'll just show you see a small video in this context. It will appear on your screen. Well, the voice may be a little lower, but I'll try to increase it. So just listen to this video, see this video and listen to it. I think it gives you almost around 10 reasons why the boards fail. And we should learn lessons that we should not be doing this while we are in a board or working as a member of the board of directors. So let me start this video now.
When running an organisation, it is important to have a board of directors who work well together. Making the right decisions and knowing what to do is called good corporate governance. This ensures that the company and everyone involved is making honest choices in the best interest of the stakeholders. So what makes a board of directors succeed? Let's look at the top 10 reasons why they don't. The first reason, boards fail. Is not having the right people. Some directors might not have the relevant skills or experience, or they might not understand the importance of their role and responsibilities as a director. A board of directors is only as good as the people who sit on them. The second reason is not keeping directors up to date with recent developments. Directors need to know their roles and responsibilities. This includes understanding financial reports. Directors should never be kept in the dark. Directors should always be informed, and new directors must be trained and equipped with the right information to help them fulfil their duties. The third reason is not knowing the rules of the organisation. The company constitution is like a rule book. It tells the directors, management and the staff what the organisation can and can't do and how it should operate. All directors should be encouraged to learn the rules and know how to change the ones that don't provide good results for the organisation. 4. Another reason is not making decisions in the best interests of the organisation. The chairperson and the directors need to promote responsible decision making. Effective decision making will keep the company strong and will allow it to grow and prosper. Number 5 is not recognising potential problems and risks that might threaten the organisation. By identifying any problems, directors can ensure the organisation is well prepared to weather any storm. Whether it's finances, management, staff or physical environment, directors must know how to deal with problems as they arise. A good way to do this is to keep a checklist of potential problems, risks, ways of dealing with them if they arise. Number 6 is not using the organisation's assets responsibly. Assets and funds belong to the organisation, not one individual or the board of directors. Directors should ensure assets and funds are used effectively to keep the organisation strong. This will leave a lasting impression on banks, government and suppliers. If assets and funds are used in the wrong way, the organisation will become weak and may not survive. The 7th reason boards fail is neglecting to pay taxes. Tax matters should be handled correctly. Tax and superannuation must be paid on time. Not reporting correctly can lead to financial penalties, cash flow problems, and angry taxmen. Having people who understand taxes will help to address these issues. Reason number 8 is not knowing the organisation's financial position. Financial reports indicate if funds are being managed properly. If directors are worried about the organisation's financial position, they should talk to the company auditor. Reason number 9 is trying to do everything at once. Directors need to have a clear direction on where the organisation is heading. Board governance takes time and priorities must be set years in advance. All boards should have a good idea of the organisation's mission and what success looks like. Directors and management should work in partnership to establish key goals and priorities. 10. The final reason boards fail is a lack of teamwork. Directors and management must work together. If conflict and tension arises, it can interfere with the board's ability to make decisions. Constructive conflict can improve the decisions made because it's valuable to consider many points of view. Sticking to a well thought out strategic plan will give the board a direction and will minimise conflict. Good governance is made up of many different elements: teamwork, communication, transparency, financial audits. A code of ethics and effective reporting contributes towards an effective and productive board. And a productive board means a successful and profitable organisation.
Okay, so friends, I think we have understood from this particular the video that what are the reasons why the boards fail. Now, if you would have noted, particularly in respect of the compliances, well, friends, let me share with you that compliances are one of the biggest things nowadays. Now, as independent director or a director in a company, I think we must make sure that the company is complying with all the laws. Now, that is extremely important. This is where from your safety net will start. Now, if you want to protect yourself, friends, this is extremely relevant point where the protection starts from the compliances. Now, the big question is that how can I make sure as an independent director that the compliances are being done? Because as an independent director, you are not looking after the functioning of the company on a daily basis, as we call it as day-to-day affairs. You are there maybe for some board meetings, you are attending board meetings. So how can you protect yourself? Now that is also an extremely important point. Okay, so anyhow, these are few things. I think most of us understand the Companies Act, so I need not devote too much of time. I've already explained to you that there is a corporate identity number, which is an alphanumeric number. I've already explained to you how it is to be deciphered. Then director identity number. Every director who is going to become a director or is a director in a company must have a DIN. And of course, you can't have more than one DIN. So if you have more than one DIN, that needs to be surrendered. And then digital signature certificate. well, directors may or may not have them because it's not really mandatory, but definitely it is required. Well, in companies, we may have a holding and a subsidiary relationship, right? We also have the concept of associate companies nowadays. Well, I think most of us are aware what do you mean by holding and subsidiary companies. Some companies can be 100% wholly owned subsidiary, some can be, you see, subsidiary. So those requirements under the law are little different because it requires consolidation of the balance sheets of the subsidiary into the main holding company. So controlling the composition of the board or more than one half of the total share capital, the other company becomes its subsidiary or a holding company. And similarly, we have a new concept of associate companies under the Companies Act. I think now everyone is aware of that. If one company has a significant influence over the other company, then the first company is known to have, then the second company becomes the associate of the first one. And significant influence here means the controlling of 20% or more of the total share capital or controlling the business decisions under an agreement. So these are the two conditions by which a company can said to have a significant influence over the other, and that is the reason one company can be called as an associate company. And then friends, as chartered accountants, I think we are always aware that there could be related party transactions. So related party transactions are also very crucial when you are an independent director of a company or even a director of the company, because these are certain related concepts. I call them as related concepts, like the definition of relative is given in the Companies Act. Then the definition of related parties is also given. Then the Companies Act also deals with related party transactions. So they should be at arm's length. So all those, you see, things are already mentioned there. These are extremely important, right? So related parties and related party transactions. So if you are a director of a company, friends, I think it is extremely crucial that you must know the significance of these, or rather meaning of these also. So the definition of relative is very interesting in the Companies Act. So you must go through those definitions. And related parties, of course, is very, very long definition. So one has to really understand the import of it. But anyhow, if you are a director in any company, well, you just have a look at the financial statements, and in the notes to accounts, we always find that the auditors have also disclosed, or the management discloses, the names of the parties which are related parties. So you get to know many things from the balance sheet itself. And then, of course, as we mentioned about that, these are the two very important documents of a company: memorandum and articles of association. I think most of my friends are aware, so I don't have to deal with what is memorandum and what is article, but I can only explain in one single sentence. Memorandum of association defines the relationship of the company with the outside world, whereas the articles of association of a company, now they define the internal rules of the company, how the company's board meetings are to be held, what will be the quorum, what is the powers of the chairperson, and so on and so forth, what is the length of notice which is to be given. So internal affairs are dealt in articles, and second is memorandum, which defines the relationship of the company with the outside world. But these two documents, friends, are extremely important, and you must have them in your library if you are a director in a company. And I'm emphasizing it time and again, and I'll show you why it is important. Now, I think most of us are aware of the contents of the memorandum and articles. But are you aware that Companies Act introduced a very interesting provision which talked about entrenched provisions? Now, what is an entrenched provision and how it is helpful? Let us try to understand that. The meaning of the entrenched provision is this: that articles of association, we are aware that it can be altered with the 75% majority or the voting power, and the articles of association can be amended. Now, entrenched provisions are those provisions which cannot be altered by 75% majority, but they can be altered by a specific majority which is specified. Now, how it protects, you see, certain class, I'll tell you that. What happens is that sometimes you're all aware that, you see, companies can be formed as a joint venture also. There are a lot of joint venture partners. And when a joint venture is being formed, people do take my advice, what should be my percentage? So I tell them that, look, number one, if you are a majority partner, then you should try to have more than 75%. That means 76 plus. That is why we know there are certain joint ventures which are 76-24. The second type of, you see, joint ventures could be 51-49. So now it is less than 75, but it is more than the 50%. That is the majority. So, but the other party is not in majority. They are holding 49%. The third type of majority could be, say, more than 90%, and the minority gets less than 10%. Now, what is the significance of this 90%, 76%, or 51%? Well, friends, when your company, supposing entering into a joint venture, and the majority joint venture partner, first of all, will try to keep you under 10%. Why? The reason is simple. Because if you hold more than 1/10 of the share capital or 10% of the total share capital, then as minority shareholder, you are entitled to approach National Company Law Tribunal (NCLT) for oppression and mismanagement under Section 241, 242 of the Companies Act 2013, which were earlier 397 and 398 under the Companies Act 1956. So these are the two specific provisions which can be used by minority shareholders, provided their shareholding is more than 10% or more, minimum 1/10. So therefore, if you want to become really a majority partner, well, you should try to get it more than 90% so that the minority is not in a position to file the minority application. And if you are in the minority, please try to get it more than 10% or more. So this works both ways. Then next comes is 76-24. We know the significance, because if you are holding 76% of the shareholding, then you can, as a majority partner, definitely now what you can do is you can change the articles of association and memorandum of association, because it requires what? It requires 75% majority. So this is the second type of limit. So if you are not getting more than 90%, then the person who is a majority partner wants to get more than 76% and keep the other party less than 25, so that you can alter the articles also as per your wishes. And you can pass a special resolution, because it requires special resolution. Then the third one is, if you want to be purely a majority partner, then it could be 51%. Then at least in the board meeting, well, some resolutions can be passed, or ordinary resolutions also can be passed, but not the special resolutions. So this is the way things are there. But let me also tell you now more about entrenched provisions. This provision actually protects the minorities, whether less than 10, whether less than 24, 25, or whether less than 50%. So it could be 10%, 24%, or 49%. How it protects? Entrenched provisions means that there are certain provisions, certain clauses in the articles of association which cannot be changed with just 75% majority, or by simply passing the special resolution. But if you say in your articles that this clause is an entrenched provision, so you can name any clause as an entrenched provision, and you can also say that if it is an entrenched provision, it would require, say, either 100% of majority to change, or maybe say more than 90% or whatever. So that's your choice altogether. So this remains entrenched in the articles. It cannot be changed with a specific majority or unanimous approval. But you need to specify that. That's very important. Okay. So if you are a minority joint venture partner, you can definitely make use of this, because Supposing your article say that a board meeting cannot be held unless one of my representatives is present, like as a minority shareholder, director is present. But this can be altered. And if the articles of association can be altered, then the majority partner can always change it if it is more than 75%, if they have. So, but if it is an entrenched provision, then they will not be able to change unless, supposing your entrenched provision says it can't be changed unless it is approved by 100% majority. So now certain clauses cannot be changed unless you also give a positive vote. That means that you have got a veto power now. So entrenched provisions are very, very useful. Please try to make use of them. You can also advise your clients to make use of this. Okay, so this is extremely important. Then, of course, we are all aware that there is a very important section, Section 6 in the Companies Act 2013, which tells us what is the hierarchy of the certain documents in the Companies Act. Well, Companies Act is always on the top, as we all know. So Companies Act is always at the top. Then Memorandum of Association. Then comes Articles of Association. So this is the hierarchy. So no provisions in the Articles of Association can be against the memorandum and against the Companies Act. Similarly, no provision in the memorandum should violate the Companies Act, because otherwise the act is generally known as it is ultra virus. Ultra means beyond, virus means the powers. So this is the reason why we call it as this. Well, companies are managed by the board of directors. So here comes the responsibility of the directors. So director may have certain powers, may have certain responsibilities as an individual director, but then the board of directors in all may also have collective powers, and that is known as the powers of the board of directors. This is extremely crucial, friends. Okay, and of course this is also very important, and as independent director we must be aware, because in the beginning itself I mentioned that some people are afraid that they will be held liable for the penalties under the Companies Act if something goes wrong. Well, definitely the violations of the Act, Companies Act, are punishable in nature. There is no quarrel to that. And if we look at the Companies Act, we can summarize it like this. Some acts, offenses, or the violations of the Act are punishable with fine only. Some are with fine or imprisonment. Some are with fine and imprisonment, so both. And then some are with imprisonment only. So this is very important, friends, that we must know what are the consequences of not following the Companies Act. That is one part of it. And the liabilities with imprisonment and with the imprisonment only and fine and imprisonment are mostly relating to those prospectors and particularly relating to public deposits. So wherever you're dealing with the public money, the government is actually very, very serious. And of course, in Companies Act 2013, now we have got a new provision which is known as fraud, and that is defined in section 447. So 447, my dear friends, is one of the critical sections in the Companies Act, and as directors you must be aware what you are getting into. That's very important, and I've got few slides, 2-3 slides on 447, so we'll deal with that. But let's also answer $1 million question: who is liable for the violations of the Companies Act? Now, before I give you the specific answer, let us try to understand in a different manner. If you look at Companies Act, friends, there are 3 concepts which are there now. One, we call it as officer. That means there are officers in a company. Then we have got officer in default. Now that is also second part of it, that there is a concept of officer in default. That means if there is a violation, then who is going to be held liable for this particular particular non-compliance? That is also extremely important, friends, right? Officer is defined in section 2 clause 59, and officer in default is defined in section 2 then subsection 60. That is also extremely important for everyone to understand that and read it. Now, let me also take you to few provisions of the officers and officer in default. Now, that's also very important. And then a new concept was introduced in the Companies Act. Now, that is also known as key managerial personnel. Now, key managerial personnel is defined in section 2, subsection 51, KMP. KMP is a very, very interesting definition if you look at KMP, friends. Now, KMP, as the word suggests, it is known as key managerial personnel. Personnel is a plural term. That means not only a single person is included or considered as KMP, it is actually the more than one person. So who is covered under KMP? Number one, the Chief Executive Officer, CEO, or the Managing Director or Manager. So they are considered as KMP. That is a one category of people: CEO, MD, or the manager of the company. And well, friends, when I say the manager of the company, now manager of the company, I'm not talking about manager in ordinary sense. Manager here means the person who is enjoying substantial powers of the management. Now that is also very interesting part, right? Now the definition of you see managing director is given in the Companies Act, and similarly even the manager word is also defined. So that is also very important, that we must know what is the meaning of a managing director or the the manager. Now that is very, very important. Now, if we look at the definition of the word manager, now the manager here means is that the person who is managing the whole or substantially the whole of the company. So that is the person who is known as manager. And managing director is also defined in a similar manner, but it says a managing director is a person who enjoys the substantial powers of the management. So now you must be wondering, what is the difference between MD and manager then? Well, the difference lies in this. A managing director, as the word suggests, the person has to be a director first. If a person is not on the board of the company, then the person cannot be appointed as a managing director. But on the other hand, a manager need not be on the board. And second thing is very important. A company can either have an MD or a manager. It cannot have both. That's very, very important. Okay. So this is first category of the KMPs which are there. The second category of the KMP is the company secretary. So company secretary is also considered as the KMP. Third, and company secretary here, I mean, is the company secretary who is working in a company. And then the next category is the whole-time director. Whole-time director means a director who is in the whole-time employment of the company. And the next category is the CFO, that is the Chief Financial Officer. Then lastly, it used to say that such other officer as may be prescribed. So government has not prescribed any so far. But then there was a question whether any person can be designated as a KMP by the board of directors. Well, that particular clause was missing in section 2, subsection 51. But later on, the government actually amended the law, and they amended it somewhere in February 2018, and they added a clause and they said that such other officer, not more than one level below the directors, who is in whole-time employment of the company, can also be designated as KMP by the board. So now even the board has also got powers to designate someone, but not more than one level below the board of directors. Right? And secondly, they must be in the whole-time employment of the company. So they can be designated as officer in default. As the KMP. So this is the whole definition of the KMP now. So manager, managing director, CEO, company secretary, whole-time director, CFO, and any other person who is in whole-time employment of the company not below than one level below the board can also be designated by the board as KMP. And lastly, such other person as may be prescribed, the government has not prescribed any other person. So these are the people who are called as KMP, right? Now, the concept of officer and officer in default is very important now. Why it is important? Let's try to understand, because it has got a great significance. It has got who is liable actually can be answered from this. Well, officer, if you go to the definition of officer, which is given in 259, 2 subsection 59, now it says officer includes, in fact, it's an inclusive definition. It says includes any director or manager or KMP. Now here the word used is KMP. Look at the huge word. Or any other person in under whose directions or instructions the board of directors is accustomed to act. So those people, you see, are known as the officers of the company. So to rank as an officer, well, you need not be a board member. You can be, you see, a manager, you can be a KMP, or any person who is acting from outside, giving instructions, and internally the board of directors are accustomed to act in accordance with the directions of that person. Like supposing Mr. Narayana Murthy, who is not in Infosys, but he gives advice to the board and the board acts on that advice. And generally it acts on that advice, then it can be mentioned or it can be called that they are known as the officers of the company. Then let us go to the definition of officer in default, because friends, who is liable actually depends upon the officer in default. And as the word suggests, that if an officer is considered to be in default, naturally he's going to be liable. So now the greatest mantra is, let me tell you, this is a very important thing. If you are an independent director in a company, now if you are held liable, why will you want to become an independent director? Because you don't want to undertake, you see, liabilities. So the protection starts from here. I told you that in the beginning that we need to create what? We need to create the safety net. How will you create a safety net? The safety net is created like this. That number one, officer in default, a whole-time director is included or considered as a officer in default. Second, key managerial personnel is considered as a officer in default. Then third situation says that where there is no key managerial personnel, KMP, then any director or director who is specified by the board that this person will be the officer in default. And mark my words, friends, now, if no officer is indicated or specified, then all the directors are considered as officer in default. So now what is the, you see, main thing what we are getting? If we are a director in any company, friends, then we must become a director which has a managing director, which has a KMP, which has a whole-time director. Then you are at the fag end to be considered as an officer in default. So this is what the liability also exists on, you see, the people who are officer in default. So this is the definition of the officer. I think we have already covered. And this is the definition of the officer in default. So this is very important, that if there is no KMP, then you must have some specified director. Specify somebody who is responsible. At least you are escaping your liability as an independent director. And if there are no specified directors, then the entire board is responsible. So friends, this is extremely, extremely crucial for us. Okay. And this is a very, very vast definition. And I would just like to draw your attention to the last part of it. Officer in default also says that every director who is aware of such contravention by virtue of receipt by him any proceedings of the board or participation in any such proceedings without objecting to the same, or where such contravention has taken place with his consent or connivance. Now friends, officer in default is a very vast definition. Now supposing there is a contravention in the company, and this contravention is known to that director, by virtue of receiving the proceedings of the board. That means either the minutes of the board meeting or the agenda or the notice. Or he participates in a certain meeting and he knows there is something wrong, but he does not object to the same. Even then, the person becomes an officer in default. Every director becomes an officer in default. So therefore, what is the lesson which we are learning? The lesson which we are learning from this is that if I am a director in any company, friends, silence is out of window. We will not remain silent. We need to raise our dissent. We need to raise our voice. We need to object to whatever is happening which is not in accordance to the compliance of the law, or if there is a contravention is there. So therefore, friends, do not remain silent while you are sitting on the board. So have your dissent recorded. That's very, very important. Now let me take you to a very interesting concept, or very important concept on the other hand. And in fact, this concept is extremely important even for the auditors. Now, section 447 first gives us the penalty, that this is the penalty for the fraud which is there, because I told you fraud is now being considered very seriously under the Companies Act, and at many places you will find that the directors can be held responsible for fraud. So the safety net, friends, starts from here. I don't think you want to, get involved in the frauds itself, isn't it? So, and even if it is, then we will have to consider ourselves that we should not be penalized. So let us look at, these are the penalties part. So I can skip this, but let us try to understand what is the meaning of fraud. The meaning of fraud, friends, is given in the explanation underneath section 7, which is a very long definition and it's a serious definition, friends. It says fraud in relation to affairs of the company or any body corporate includes. First, friends, I am actually very concerned with the definition because it is an inclusive definition, not a meaning definition. Secondly, look at the use of the word any in the entire definition. It says includes any act, omission, concealment of any fact or abuse of position. So any has been used 2 times in this sentence. Then it says committed by any person or any other person with the connivance in any manner. Such a broad definition. Next one, with an intent to deceive, to gain undue advantage from or to injure the interest of the company or its shareholders or its creditor or any other person. So even any other person is also included here. And the last part of this definition is most serious, friends. Those who are lawyers probably will understand the impact of this, whether or not there is any wrongful gain or wrongful loss. Now, under the criminal provisions of India, like in IPC, Indian Penal Code, well, there has to be a wrongful gain or wrongful loss to make it as a crime. But or maybe a fraud basically, particularly. But under the Companies Act, it is written whether or not there is any wrongful gain or wrongful loss. So whether a loss is caused to the company or a gain is caused to that person or not, that is immaterial. But still, any act can be considered as fraud, provided it is with the intent to deceive, to gain undue advantage, or for injuring the interest of the company, shareholders, creditors, or any other person. Friends, this is the most serious definitions under the Companies Act. Very, very serious definition. So therefore, it is very important for us to understand. And while we are on the board of any company, friends, we must look at this definition very carefully. Okay. Well, I think we can skip all these things, laying out the balance sheets, holding of annual general meeting, filing of balance sheets. I think my friends are aware of this. So I can just skip this. Now, friends, let me take you to the second part of it now. The corporate hierarchy. This is the way the company functions, as we all are aware. This is a very simple corporate hierarchy, which I'm showing you on the screen. Well, shareholders on the top. The board of directors basically are accountable to the shareholders. Then the directors, committees, and the managing director, well, they work under the supervision, superintendence, and control of the board of directors. I think we are all aware. So this is also the statutory framework which we have already covered. So let us look at, yeah. Now this is interesting. When we are talking about independent director, well, independent director is also a director, isn't it? So now let's look at the definition of a director. Under Companies Act 1956, it has a very interesting definition, of course, which stands modified now. Now, under Companies Act 1956, the definition was an inclusive definition. Let's look at that. Director includes any person occupying the position of a director by whatever name called. So it was an inclusive definition, but it doesn't convey any meaning. Of course, it says person occupying the position of a director by whatever name called. So you may call him as CEO, you may call it as CFO, but if he is occupying the position of a director, he was considered as director. But this was a confusing definition. Now, under the Companies Act 2013, friends, the definition has slightly changed, or rather, I would say it has changed to a larger extent. So instead of an inclusive definition, it is a meaning definition now. It says director means the directors appointed to the board of directors of the company. So now appointment of a person as a director is very important to call that person is a director. So that means it's an essential condition. So this is a meaning definition. Of course, it does not give us the meaning of the exact meaning of the term director. Well, director can be defined as the person who directs the company, isn't it? So who gives directions to the company. Is director an agent of the company? Well, the answer is yes. The director is an agent because company generally acts through directors only. It cannot act on its own. Principles of agency definitely apply to the directors. And the contract is also entered by a director or by the board of directors in the name of a company. That's important. Trustee. Is the director a trustee? The answer is yes, because all the powers of the directors are actually the powers in trust, and they have to be exercised in good faith for the benefit of the company as a whole. And then whether the director is considered as an employee, the answer is that he may work as an employee. Well, if he's in the whole-time employment of the company or he's a managing director, well, definitely he can work as an employee also. So this is there. This is one book, friends, which I have authored and published by LexisNexis. These are the largest publishers, law publishers in the world. This book actually talks about roles, responsibilities, powers, and duties of directors. Well, this book contains, friends, 26 chapters. The last chapter talks about the safety net, that if you are a director in a company, how you should create a safety net around you. Well, friends, let me tell you, of course, all of you are professionals, you understand the technical jargon and other things also. But this book I've actually written in a very simple language for the directors to understand their responsibility. So there is no technical jargon, there is no other jargon. And of course, this is one of the book which I have authored on insolvency and bankruptcy code. It is a commentary. Of course, as directors, friends, we must be also aware about the insolvency and bankruptcy code, because a company can face insolvency and there are certain liabilities which are also, you see, can come over the directors. So this is very important for us to understand. I think this I can skip because we all know what kind of directors are required, women director and nominee director. But let's look at this. A nominee director, yes, this is very important. Now this word nominee director was not defined in the Companies Act 1956. But when we come to Companies Act 2013, friends, nominee director has got a definition now. What does it mean? It says a director nominated by any financial institution pursuant to law, agreement, or appointed by the government or any other person to represent its interest. So simple definition now. But one thing it has clarified, one thing is now clarified is, earlier there was a confusion under the Companies Act 1956, whether a nominee director can also be considered as an independent director. Well, the answer is no, as now it has been clearly mentioned in Companies Act. And the simple reason is because if somebody has been appointed to represent its interest, the other party's interest, obviously he can't be an independent person. So therefore, nominee director is not considered, cannot be considered as a nominee independent director. Of course, this is I'm going to skip this, but one thing is very important, friends. Some people do ask me, how should I choose a company to become a director? I have already passed the examination of independent director. My name is also on the, you can say, in the list of independent directors, but nobody is appointing. Well, that is a separate aspect. Definitely, you will have to do some networking. Only then the person will know that you are also a person who can be appointed as a director. That's one part of it. But if you have to choose a company, supposing an offer comes from a company for you to be appointed as a director or independent director. Now, some due diligence is required on your part. You will not jump and accept the position of a director in a company just like that. So now, what are the you see those kind of uh, acts or the things which you have to look at it? The scrutiny, what you need to do, or due diligence. Friends, the first thing I must tell you is this. Let's look at the provisions of the Companies Act first, particularly relating to disqualification of a director. Let me take you back to Companies Act 1956. What did the Companies Act 1956 said? It said that if a person is a director in a public limited company, so on the one side, you are a director in a public limited company. And if that company has defaulted in repayment of its deposits, interest, or the principal, and if the company has also failed to file its balance sheet or annual return for consecutive 2 years, then the person who is a director in such company cannot be appointed as a director of another public limited company for next 5 years. So let's understand. Under the Companies Act 1956, this was a provision. If a person is a director in a public company which has defaulted in this, then the disqualification gets attached to that director, and that person could not have been appointed a director in any other public limited company. So both sides, it was public limited company. When Companies Act 2013 came, it drastically changed that provision, friends, and it made it more serious. Now, what was the drastic change which was made? The change which was made was this. Instead of public company, the word any company was used. And similarly, on the other side, any company was used. So what is the meaning of that? If a person is a director in any company, and if that company has defaulted in payment of its debentures or public deposits, principal or interest, and for a period of 1 year, and it has failed, either it has failed to deposit or file its annual return or balance sheet for next 2 years, then such a person cannot be appointed as a director in any other company for next 5 years. So friends, this disqualification becomes personal. So therefore, it is extremely important that you should choose the company carefully. Please do your due diligence whether the company has committed any default in terms of the repayment of the public deposits or debentures or interest and principal, or has not filed its balance sheet or annual return. Well, this is extremely crucial, my dear friends. Otherwise, the disqualification gets attracted and you get a label of disqualified for next 5 years. So please be extremely careful while you choose to become a director in any company. Okay, these are few things which obviously are written in the law, so I can just skip it because they are more procedural in nature. Let me actually take you to very interesting parts now. And these are the board committees which are mandatorily to be formed under the Companies Act, but for certain class of companies like audit committee. Then there is a new concept which is introduced, is known as vigil mechanism. This is just similar to whistleblower scheme. Then we should then a company should have nomination and remuneration committee. It is known as NRC. And then SRC is also there, stakeholders relationship committee. And of course, if CSR provisions are applicable to your company, then a company should have a CSR committee also. So these are few we call it as statutory committees under this. Friends, this provision which I'm showing you now on your screen, this is extremely crucial. Duties of directors. Well, friends, the duties of directors were not codified in the law. There was no codification, right? But when the Companies Act came, now the codified duties of the directors were specified in the Companies Act for the first time. And let's look at it. These are very, very important and crucial duties which have been mentioned, friends. So do not skip this particular part. You will have to go through the duties while you are becoming a director in any company. So what you can refer is section 166 is there, which talks about the duties of the directors. That is for the first time these provisions have come in here. Let's look at what are those. Number one, to act in accordance with the company's articles. Look at this. That is why I was mentioning or telling you all the time that you need to be, looking at the company's articles. So company's articles are extremely crucial, my dear friends. Not only having a copy, but we need to read the company's article. So therefore, because it can become a problem anytime. So therefore, it is extremely crucial that we must read the company's articles, because that is one of the duties which are there. Second, the important part is that we must also look at we must act in the good faith of the company. The director are supposed to act in a good faith in order to promote the objects of the company as a whole. Now, here comes a slight clash. Now, supposing you are a nominee director on the board. Now, being a nominee director on the board, now you are being nominated by somebody. If any decision in the board meeting is to be taken, now will you take it in favor of that person who has nominated it, or the one which benefits the company where you are a director? Well, the answer is very simple, friends. You are supposed to act in the best interest of the company as a whole. So even when there is a clash between you can say the being a nominee director and others, so you need to really look at the interest of the company as a whole. And of course, the directors have to exercise duties with due and reasonable care, skill, and diligence. Now that is also one of the codified duties now. And then they should not involve themselves in the conflict of interest. In fact, the job of the independent director is to resolve the conflict, because conflict can arise. But if the conflict of interest arises, well, that needs to be resolved. And of course, it's a very simple one, not to have any undue gain or advantage. And this is also very important, not to assign his office, and any assignment done shall be void. So that means if I'm a director in any board, then I cannot ask my son to attend it, or I can't send my proxy to attend it. So there is no assignment of my office at any place. Okay. So these are very important. And look at the contravention. The contravention or penalty is that contravention is punishable with a fine which shall not be less than 1 lakh rupees, but which may extend to 5 lakh rupees. So you do not want to be penalized, because there should not be any contravention. So codified duties of directors are very important. Now, friends, now let's come to the core subject of the role of independent directors. Now, this is extremely important. And friends, if you have any questions, maybe you can put it in the chat box. So I think then we will be able to answer those questions in a little while. What we can see is now is what is the role of the independent director. Let's look at this. This is extremely important. First, what is the meaning of independence? Why do we call a person as, how do we call that person, that this person is an independent director? Well, of course, the meaning or the definition of that is given in section 149 subsection 6. One can look at that. Not having material pecuniary interest and so on and so forth. There are many other conditions which are mentioned there. But the most important part is, I say that independence is a state of mind. If a person thinks independently. If a person thinks he is independent, only then he is independent. So independence, according to me, is a state of mind. This is extremely crucial, right? Now, the other part is that who appoints the independent directors? Actually, if you ask me, the independence actually emanates from this particular thing. Now, who appoints independent director is extremely crucial. Well, friends, let me share it with you. Under the Companies Act, of course, the directors are appointed by the shareholders, including the independent directors. So now, and generally in India, we have seen in majority of the companies, they are promoter controlled companies. That means the directors have the majority power, and then they can decide who is going to become a director or not. So they can also, when the independent director's tenure is ending and his reappointment is coming forth, so promoters can always say that, look, we are not appointing him. So this actually affects the independence of directors. Of course, now their tenures are, fixed now. But at the end of the day, this can actually make a difference, isn't it? So what the government is trying to do, and number two, what they are trying to do is, now SEBI has come out with some consultative paper. And now SEBI says, very interestingly, they say that now there has to be kind of a dual kind of an approval in case of the independent directors. Number one, now they should be appointed by, the shareholders minus the promoters holding. Now that is actually very, very crucial thing which is mentioned now. So of course, those changes are basically applicable for those who are coming under who are listed companies. But yes, this is a welcome provision. Now tell me one thing, whether independent directors are policemen in civil clothes. Well, initially when this provision came of independent directors way back in 2002, 2003, now everyone thought that independent directors are there to pinpoint mistakes, and the promoters were looking at them with a suspicion that independent directors will always be there to point out certain things and not be helpful in running the company. But let me share with you that they are not policemen in civil clothes. Well, they are there to not to run the business also, but they are to keep an eye on whatever is happening in the company. So if there are good things are happening and normal business is happening, I don't think they should create a bottleneck. To that extent, we are very clear in our minds. So they are not actually policemen in civil clothes that every time they'll have to look for something bad here. So it's a degree of independence which matters, right? That is very, very important. Now, one question which is also comes to our mind is, now should independent directors possess business intellect? Well, if that becomes a requirement, then tell me, friends, where the chartered accountants or lawyers will go. Because you as a chartered accountant and lawyers, as they have expertise in a particular area. Now we are not there who have got knowledge of the business. So therefore, having a business intellect is not the prerequisite. But having said that, one of the important aspect is this, that don't you think that you should know about what the company is functioning is? Because let me share one of my examples. I was appointed as a director in Shipping Corporation of India, which is a government company. Now, I knew nothing about the shipping industry. And of course, because if you are not dealing with that, you don't know. But then in our first 2-3 board meetings, we also became used to, we understood the business of the company. We were acquainted with the technical terms like wharfage and other things which are specifically used in the shipping business. So by, I think, 1 or 2 board meetings, we also came to know that what is the business of the company, and then we started contributing towards the company, isn't it? And same thing can happen with you. So even if you are appointed as an independent director in any company for which you do not have any knowledge of the business, you are not supposed to. But then try to gather as much information so that you are able to see, like I was also appointed in a company which was manufacturing earth moving equipments, and that too it was located in Hosur. Now, uh, we should know who are our competitors. We should know what the company is manufacturing, because they were manufacturing, you can say, industrial generator sets. So we came to know after visiting the floor shop that these are the products which are being manufactured, and these are new products in the pipeline, and these are our competitors. So those kind of things I think are required. So updation of knowledge of the business is extremely required. Do independent directors enjoy any freedom? Well, friends, the answer is yes. There are a lot of freedoms which the independent directors do enjoy, but these freedoms are not unfettered, my dear friends. Well, if something wrong is going on in a company, it is a duty of a director to point it out and discuss in a board meeting or bring it to the notice of the board. But he is not supposed to go to the you see, press, or make a public opinion about that, because freedom does not mean that they can speak anything at any time. Only thing is, yes, they can question the methodology, they can question the transaction, they can question the people who have entered into the transaction, and having not satisfied with that, then of course there are certain views which can be done. But something has to remain within the four corners of the company initially. If something unlawful is going on, obviously, then the director is supposed to blow the whistle. Now, another interesting concept in independent director comes is, should the independent directors be remunerated? That is the first question. Well, if I ask to the 100 people, I think I get from 95 that yes, they should be remunerated. 5% of the people, they always say that there should not be any remuneration. Well, of course, I also don't agree with this concept that there should not be any remuneration. And definitely, I feel that independent directors, if they are spending their time, obviously, and they are bringing the expertise on the table, well, they need to be remunerated. Now, the next question is more important than whether they should be remunerated or not. The second question important is, how much should be their remuneration? Now, that is also extremely crucial. How much? Now, how much is answered by the Companies Act first. Let's look at the provisions of the Companies Act. Companies Act says that a director can get sitting fees. Of course, sitting fees is very nominal and it depends upon the scaling, so that can be paid. The second is that a person who is not a whole-time director, because whole-time director or MDs, obviously they can get salaries and other things or perks. But insofar as other like part-time directors or independent directors, well, what they can get, the Companies Act says that if there is a managing director or whole-time director, then the director's simpliciter, they can be paid up to 1% of the net profits of the company. So including the independent directors, they can get this. Obviously, first the articles must permit it, then the board must pass a resolution, and then of course nomination and remuneration committee, if it is there, they must also approve it, recommend it. Now let us look at you see, one of the things, and if there is no managing director or this thing, if it is a board governed company, then this can be go up to 2% of the net profits of the company. And of course net profits have to be calculated in accordance with section 197. Now, one of the important aspect is, let's look at this. If a company makes a profit of say 6,000 crores, what is 1% of 6,000 crores? Well, it comes to 60 crores. Supposing there are 6 directors, independent directors in a company, or say directors only, and the board decides that let us give 1% of the net profits, and that should be divided equally amongst the directors. So every director, my dear friends, including independent director, gets 10 crores each. Now tell me, after this, does he remain independent? Because if in the next board meeting or the next year, if he starts pinpointing the fingers, then the board, the board of directors, which are generally promoter controlled boards, now they can pass a resolution saying that this 1% should not be paid. Then what happens? The director loses that money. So therefore, you see, the reasonability has to be determined, because well, everyone has a certain kind of a value. So therefore, one has to see whether the directors should get reasonable remuneration or not. Well, the Companies Act permits it, but what is reasonable will depend upon the facts and circumstances of each case. And of course, skill enhancement is very important for the board of directors, and we are seeing that a lot of updations to the board of directors and independent directors is required to be done. Like today, we are having a seminar. Of course, some of you may be directors, so this is known as the skill enhancement, which is there. And tenure of IDs, independent directors, is also fixed, as we know. Now, the biggest question that comes is, why do we need independent directors? Of course, one is the requirement of the law. Well, law requires it, so therefore we have independent directors. But otherwise, my dear friends, if we look at the need for the independent directors, well, these are certain answers which need to be given. Well, on your screen, friends, you can see a picture. Now, while looking at this picture, I generally ask a question to the audience. Of course, here probably you cannot answer it by opening your mics, but otherwise, I generally ask everyone that look at this picture and tell me which stone represents the independent director and why do you think so? So some people say like a middle vertical stone, and some people say the horizontal, middle stone, or maybe one stone on the top, or maybe one stone in the bottom. So people have different opinions. And then when they give their complete logic, I think that is also interesting, because some people say that independent directors have to maintain balance, and some people say that if that by one stone the balance can go up, so maybe the smallest of the stone can be represented there. And some people say, can you see one stone at the back, you see on the bottom rock, which is half visible? Some people say independent directors represent that rock, that stone. Well, they say nobody bothers about them, so therefore they are independent directors like this. Well, everyone has his own opinion, but at the end of the day, what is the need for the independent directors is that impartiality, because we want to bring something unbiasedness in the board. Then focus and perspective about the industry. That's also important. Then third is expertise. We definitely want expert people to be on the board, like chartered accountants who become directors on the board. Obviously, they are bringing about their financial expertise on the board, isn't it? And then, of course, their job is to resolve the conflict of interest. So resolving conflict of interest is also important. And then networking ability, because what happens is, supposing issue relating to, say, some legal issue comes, and you are on the board as a director, and you, because of your network, you know that this lawyer can help you, say in maybe a GST matter or any other matter. So networking ability of the directors also help them, that they should also become the directors. And the role is very important, friends. As far as the role of independent directors is concerned, of course, the role is also mentioned in the code of independent directors, which is in schedule number 4. But Hample Committee on Corporate Governance, it clearly stated that independent director A should be, now that's very important, they said it should be cooperative. Can you believe this? On the one hand, promoters always look at independent directors as non-cooperative. The word which is used by Hample Committee, it suggests that independent directors should be cooperative, they should demonstrate objectivity, and thirdly, robust independence of judgment when necessary. Well, these are very, very 3 important words, friends, which needs to be the CDR. We call it a CDR: cooperation, demonstrating objectivity, and robust independence of the judgment. Okay. And this was way back in 1998, which happened. Now, as per the Companies Act, friends, 1/3 of the directors should be independent in listed companies, and minimum 2 directors must be independent in a public company with a paid up capital of 10 crore or more, or turnover of 100 crores or more, or aggregate of loans, borrowings, debentures, deposits exceeds 50 crore rupees. So these are the requirements to have independent directors as per the Companies Act. Well, of course, the requirements under LODR are slightly different, so those kind of there. But this is one of the important new concepts which are coming up now, friends. I'll just take 10 more minutes to conclude my presentation, and then probably we can have 15-20 minutes for a question answer session. Should there be a lead independent director? Now that is very, very important, because there is a new concept which is developing, is like supposing there are 5 independent directors in a company. Now, should we call somebody as a lead independent director so that the discussions can take place in a proper manner? Well, that's a debatable, provision, which is a debatable concept. But some people are saying that yes, there should be a lead independent director also. Separate meeting of independent directors, well, this is a requirement of a law also as per the code of directors, and a separate meeting is required at least once in a year so that they can discuss, they can evaluate the performance of the other directors also. But mark my words, friends, if you take it too seriously, then sometimes it becomes a problem also. Anyhow, the code of conduct is already there under the Companies Act, schedule number 7, which is there, schedule 4. So we must look at this schedule to look at this. And then, of course, maximum directorships, remuneration, and all those concepts which we have already discussed. Performance evaluation of directors, board, and committees is required to be done now. So not only the other directors, even the performance evaluation of the independent directors is required to be done. And that is also done, that how many meetings you have done and all those contributions what you have made. So due diligence and consideration in accepting a directorship, as I've already mentioned, be extremely careful. While before you become a director, ask as many questions, get a copy of articles, get a copy of memorandum, go on Google and search about the company, whether there are any pending complaints and all that. So if you don't do due diligence, friends, well, you are actually breaching your own safety net. And of course, there are few challenges which are faced by the directors. So we are just skipping that. But now let me, deal with 1 or 2 more very important concepts. Friends, these are very interesting things. You looked at the video in the beginning. It was talking about the management and also the board of directors and the relationship. I call them as governance and management. These are 2 separate concepts which are there, right? Governance means strategy oriented. That means somebody is making a policy. The other one is executing the task. That is task oriented. Then focus is external in governance and focus is internal in management. Of course, better governance leads to better management. Now, this is interesting concept. So I'll just deal with this in just 5 minutes, and then I will leave the field open for the questions. Friends, when I was a director in few companies, prior to that, I always felt that where the governance ends, the management starts. That means there is a very thin line between the governance and the management. And the governance functions are given on the left side of the screen: strategic management, stakeholders' interest, management oversight, and so on and so forth, risk analysis. Management functions are policy implementation, admin, operations, communication, compliances, performance, etc. But what I found, based on my experiences, that there is not a thin line between governance and management functions, but there exists a box, there exists a gap, and I actually termed it as a governance gap. Well, this is one of the theories which I propounded. I've written a research article on this called as theory of governance gap. Well, I think this requires further research on this particular aspect, but there is a gap which is between the governance and management. Now, what are the ingredients of that gap or the components of that gap, which I also mentioned? I said there is a perception gap, there is a communication gap, strategy gap, performance gap, and compliance gap. So what the policies are made by the board of directors, do the management understand what is the policy? Are they in a better position to communicate with each other? So there are a lot of gaps which are there. So therefore I found that these are the governance gap components. Now what are the idea? The idea is, being an independent director or a director on the board, idea is to fill this gap as much as possible. Now here comes the answer. Am I there to do business? The answer is no. As an independent director, I'm not there to do business, but we must have some knowledge of the business. And then we must also understand the perception of the management while we are sitting on the board. Otherwise, there will be a perception gap, because on the ground, things may be different. While sitting in an air-conditioned boardroom, we can make a policy, but on the ground, things may be quite different. So therefore, these things are extremely important for any board member to accept that. Okay, now friends, let me take you to, these are the few which are the at the heart of the corporate governance: independence, disclosure, transparency, ethics, risk assessment, and risk containment or management. Well, friends, let me show you. This is one of the interesting things which is there. Uh, these are the slides which I borrowed from the Infosys balance sheet. One single slide, my dear friends, tells us about risk assessment and management. Now it says on the top, if you look at it, it says risk governance. Risk governance, friends, exists at the corporate level, business unit level, and subsidiary companies level. And on the left side of the screen, you will see that there is a process which is known as identifying the risk. So there are internal risk factors, external risk factors, and then there are business objectives sought to be achieved. Then the process of risk assessment and control starts. So you assess the risk, reporting risks, then risk is controlled, and then you develop the capabilities because where the risks are there, and then again in the organization processes and systems, and then you again go back in assessing that risk. So one single slide, friends, completely tells us what is meant by risk assessment and management. So this is extremely crucial, friends. Well, other few slides are also borrowed from Infosys, but I will not bother you much on this. But this is one of the things which Infosys thought that this is their risk factor, concentration of revenues. So there's a high concentration in any single business segment exposes them to the risk inherent in that segment. So they actually tried to reduce this particular risk on a very, very positive basis. So these are a few figures which are there. Now, let me show you the last two slides of my presentation. If you are sitting on the board, how do you make sure that you are protected? Well, my dear friends, you can control certain things in the company, and you must make sure that in every board meeting, these things are discussed. Of course, annual operating plans will not be discussed in every board meeting, once in board meeting. Capital budgets must also be placed before the board. Results of the company and its divisions and segments. Minutes of the committees of the board. You may not be a part of that committee, but I think they must be placed. Information on senior level management must be placed before the board. Any show causes, demand notices, prosecution notices issued, well, they must be placed before the board. Accidents, dangerous occurrences, and pollution problems must be discussed. And then default in the financial obligation. If it is there, then it should be looked at. And then details of the joint venture or collaboration agreements have to be seen. So joint venture or collaboration agreements which are done, so that needs to be seen. And then of course, we should be placed before the board. So you should really insist on that. Significant investments made in assets, trademarks, or goodwill. Well, brands, goodwills are something where there can be huge misappropriation of money. Related party transactions, of course, has to be seen. Labor problems must be brought to the board. So if you are a part of the board meetings, well, you should insist on this. And foreign exchange exposures, of course, has to be seen. And the last one is very, very crucial, friends. Non-compliance of regulatory and statutory requirements. So how to control this? Well, in every board meeting, friends, you should insist on due diligence reports from, say, secretarial department. There can be a legal due diligence report. There could be, you see, a compliances report for labor laws. So all these compliances which a company is supposed to do because of its regulatory environment or statutory requirement, well, you will be protecting yourself, friends, if you are insisting for due diligence certificates from the management in every board meeting to be placed. In a lot of good companies, well, this is being done, but where it is not done, please incorporate that system so that you are absolutely safe in that sense. So this is one of the steps towards the building your safety net, friends. Okay, so friends, I'm just stopping it here, and thank you so much for being a part of it. Now, of course, if there are any questions, I'll hand it over to the organizers now. So if there are any questions, I think I'm available for those questions, friends.
Sure, sir. I'll share my screen, sir. One minute. There are some questions.
Yeah. So is my screen visible? Do you want me to close
No,
it?
screen sharing is stopped now, sir. I took the rights, so you need to
Great.
stop the presentation so you can see my screen, sir. Is my Excel sheet
Yeah,
visible?
yeah. Yes, I can see that. Yes, sir. Okay, so you just want me to answer these questions?
So we did got this in chat box because this is not a meeting mode where they can unmute themselves. So whatever that
Acha,
webinar mode, right? So
okay. So the first question is, what is LLP? Okay. So friends, I think most of us know, being chartered accountant, what is LLP? LLP is nothing but a hybrid formula. You see, better than a partnership firm, because under the Partnership Act 1932, we could form a partnership firm. But the major problem in a partnership firm is that the liability of the partners remain unlimited. So now, to get the advantage of the company and to get the flexibility of the partnership, and then also get the advantages of being a company, so a new concept was brought in 2008, which is known as limited liability partnership. So now here, the liability of the partners becomes limited, just like in the case of a company. But you still get the flexibility, because you don't have to hold board meetings like in a company. So you get a lot of flexibility in LLPs, but at the end of the day, your liability becomes limited. Now, then the next question is it better to open an LLP or a private limited company? Well, friends, it depends upon many things. And first thing, obviously, would be the tax planning. Now, because you see, in limited liability partnership, the remuneration which can be taken, or these things that could be restricted. So therefore, and the question of double taxation also arises in that. So therefore, you will have to compare the tax provisions. I would suggest that if your income levels are, say, lower levels, then LLP is a better thing. But if your levels are increasing, then obviously it is better to go into a private limited company format. That's what my advice is on a general level. Of course, it depends upon the facts of each case. Okay, some key provisions of independent directors under companies undergoing CIRP. Okay, well, friends, if a company is undergoing CIRP, let's try to understand this. One of the provisions in CIRP or IBC says that the powers of the directors shall remain suspended during CIRP, and the powers of the board shall vest in the interim resolution professional, or the RP. So here there is no question of the provisions of the independent directors, because your powers remain suspended, right? And generally in IBC we call them as suspended directors. So you are no longer a director as such. Of course, you are a director, but your powers remain suspended. So therefore, there are no key provisions relating to independent directors in the companies during CRP. But if you are a independent director and the company has still not gone into CIRP, now as an independent director, you should be aware of the provisions of CIRP, that when the company can get into that. So you should take steps that the company does not go into insolvency, because let me draw your attention to a very, very dangerous section in IBC. People do ignore that. Look at section 66 of IBC. It says that if the directors had knowledge that the company is going underwater, that means it doesn't have some funds, but still it continues the business for a longer time, and the loss is caused to the creditors, well, then the personal liability of those directors can come. So please be careful if you are a director in a company, right, which can go into CIRP. Okay. What is the criteria to test the reasonableness of commission on profits or any financial benefits paid to independent directors? Mr. Sridhar Rangraja has asked this. Well, Mr. Sridhar, I think it's an excellent question. I don't have a ready-made answer. Well, it always depends upon the reasonableness, depends upon the facts and circumstances of each case. For a company of the magnitude Reliance, even 10 crore may be considered as reasonable. But a company with a turnover of 10 crore, 100 crores, well, even 1 crore may be seen as excessive. So it really depends upon the task which is being performed, the nature of the business of the company, the scale of the company. I think that's more important. If you're taking too many responsibilities, definitely the test of reasonableness will go up a little higher. Okay, so good question though. Should the independent directors ensure that the directors and officers liability insurance policy be taken? Oh, well, that's a very interesting question. and this question is asked at many number of times to me, whether indemnity insurance can be taken. Answer is yes, indemnity insurance can be taken, but let me warn you, few insurance companies are offering that indemnity insurance for directors, but the premium is very high. Let me tell you. So it runs into lakhs of rupees also. So therefore, you need to really, look at that. Number one. Number two, despite the fact that you have an insurance policy in your name, well, my dear friends, mark my words, it does not protect you from criminal responsibility under the Act. I'm not scaring you, but every default which is made or committed under the Companies Act is a criminal default. And what the first step the board of director has to do, supposing a criminal complaint is filed, the board of director has to obtain a bail. That is the first thing which he'll have to do, he or she will have to do. But I'm not scaring you. I mean, if something is not done with your knowledge, consent, you're not a party to it, obviously nothing to worry about it. Because if we are doing audit also, we are still carrying a risk, isn't it? Something can go wrong and somebody can point out, you did not point out this thing. So every work which you do as a professional, obviously it carries certain amount of risk. So in any case, you are carrying that risk. But obviously, I told you in the beginning itself that we need to create a safety net around us, because problems may come, but they should bounce back. So some of the tips which I've given you today, and some of them are definitely contained in one of my chapters in my book. Well, I've said that, look, if the directors do this, they are ring fencing themselves. So you have to create a safety net around you. That's very important. Kindly enumerate the ways to ensure as to how the views of the IDs to be minuted in the meeting. Oh, that's an excellent question. In fact, I actually wanted to discuss this also, and I was expecting a question. Well, friends, I also faced this problem. Let me share it with you. In one of the cases, because you see, the concept of independent director was very foreign in 2002, 2003. I actually became an independent director in one of the Caterpillar companies, which is based in Chennai and Bangalore, way back in 2002, 2003. Well, when we used to ask certain questions, we were looked upon as if why we are asking these questions. So the management was not ready to give the answers easily, right? Now, of course, the situation has changed over a period of 19, 20 years. Now, independent directors are more respected and they are thought as a friend rather than that we are there to pinpoint something wrong. Now, this is extremely important. One, the silence is out of window now. I think I mentioned that. If something wrong is going on, if you are not happy with some decision being taken in the board meeting, well, my dear friends, you must have your dissent recorded or minuted. Now, that's exactly the question, how it is to be done. So you must say that, Mr. Chairperson, I am not agreeing with this particular decision. I am dissenting with this decision. So this is exactly my dissent. So you should get your dissent recorded in the minutes. Now, there is one more provision in the Companies Act. What it says, that the minutes, once signed by the chairperson, are the evidence that what happened at the meeting. And interestingly, these words are different from Companies Act 1956. 1956 said that the minutes once signed by the chairperson are prima facie evidence. Now that word prima facie has been taken out. Now it says they are the evidence. Now it changes the whole meaning. That means once the chairperson signs on minutes, it becomes the law of the land. So therefore, now we must make sure, because in every company, the minutes of the earlier meeting are circulated to all the directors, isn't it? So when the minutes are being circulated in draft, and if your dissent is not recorded, or it is not recorded in the manner in which you want it to be recorded, please point out to the chairperson in writing or to the company secretary in writing that my dissent has not been recorded properly. And then you must raise that issue at the next board meeting also. And even then, if the chairman refuses to record your dissent in that manner, well, then the choice is with you. Fight or take a flight. You remain as a director or resign. That's your choice, whether you want to remain a director in such a company or not. So this is the way the company's board democracy functions. Or if it is a serious issue, if it's a issue relating to a law, please blow the whistle. But be careful while blowing the whistle, because company can claim damages from you if you blow the whistle at the drop of the hat. So be careful what you are doing. So take legal advice. I think that will be important. I mean, consult your peers, consult your friends on this particular aspect to take full opinion. Of course, you can't disclose the things about the director into anyone, but in general, you can obviously take a legal opinion on that. Okay. Okay, so the last question is not exactly a question. They're talking about the publication on duties and responsibilities of director. Well, friends, it's a book which has been published by LexisNexis, and the name of the book is Corporate Directors, Role, Responsibilities, Duties, and Powers of the Directors. In fact, everyone scares you. Everyone talks about duties and responsibilities. In fact, this seminar heading is also there, duties and responsibilities. Well, nobody talks about powers of the directors. I think we should have one session on powers of directors also, because you see, the directors have got huge powers. My book actually deals with what are your powers. So the subtitle is duties, role, responsibilities, duties, and powers of the director. So friends, don't be afraid. You have got huge powers being a director also. Use those powers. And I think if you use those powers, you are actually creating a safety net around you. So then your duties will be much, much lighter than any other thing. So friends, I think this was the last question. I have taken almost 3 hours without a break for you also. Well, thank you for a very, very patient hearing. And before I close, I must thank SIRC and the entire team. Particularly, I can see CA Geeta ji there. Well, hats off to your teamwork, and hats off to your holding these programs on these unconventional topics, because generally chartered accountants do not want to hear about Companies Act or directors. But I think hats off to you. You guys have taken the lead, and I must thank you for inviting me. It was a sheer delight to be amongst you. Thank you so much, and over to you, Geeta ma'am.
Thank you, sir. On behalf of SIRC, I wholeheartedly thank Ashish Makhija, sir, who has readily accepted our invite to share his views on the role of independent directors in corporate governance despite his busy schedule. Sir, your session has given us a fair idea of corporate governance, intent to replace the old Companies Act 1956 to the new Companies Act, and role of independent directors, their responsibilities, precautions need to be taken, knowledge to be upskilled, compliances, due diligence in accepting directorship, penalties, prosecutions, risks, defaults, cautions to be taken, and safety measures. And reiterating and discussed on the importance of the statement, better governance leads to be better management. Thank you, sir. Thank you once again for enlightening us with your thoughts. I also thank the participants who have attended in large number. It shows how much our members are interested in upskilling our knowledge, and it boosts our confidence to do more and more programs like this. Thank you very much. Thank you, Vanendal, and we will see you.
Thank you. Pleasure is all mine. Thank you.